Private capital examines the structure, characteristics, and investment features of private equity and private debt within the program. Private capital refers to funding provided to companies outside public capital markets and represents a major category of alternative investments. Unlike publicly traded securities, private capital investments are typically illiquid, involve long holding periods, and require substantial due diligence and active management. Investors pursue private capital for potential diversification benefits and the possibility of enhanced returns derived from operational improvements, financial restructuring, and access to less efficient markets. However, these investments also involve greater uncertainty, valuation complexity, and governance challenges compared with traditional investments traded on organized exchanges. Private equity is a major component of private capital and involves investing equity capital into companies that are not publicly traded or companies that will be taken private. These investments are typically organized through limited partnerships where institutional investors act as limited partners and fund managers serve as general partners. Private equity firms actively manage portfolio companies to improve operational performance, increase profitability, and ultimately exit investments at higher valuations. Because investments are illiquid and require long holding periods, investors expect compensation through higher potential returns. The private equity model depends heavily on manager expertise, governance oversight, and strategic restructuring to create value beyond what may be achievable in public market investments. Leveraged buyout, LBO funds are among the most common forms of private equity investments. In an LBO transaction, a private equity firm acquires a company using a significant amount of borrowed capital to finance the purchase price. After acquisition, the company is removed from public trading if previously listed. The private equity manager then seeks to improve operations, increase cash flows, and reduce costs to enhance the company's value. Strong cash flows are essential because they help service and repay acquisition debt. Successful restructuring and operational improvement allow the fund to eventually sell the company at a profit. However, high leverage increases financial risk, particularly during economic downturns or periods of weak operating performance. The program also distinguishes between management buyouts, MBOs, and management buy-ins, MBIs. In an MBO, the existing management team participates in acquiring the company alongside the private equity sponsor. Because current managers already understand the business, MBOs may reduce transition risk and facilitate operational continuity. In contrast, an MBI replaces the existing management team with new leadership selected by the private equity manager. MBIs are often pursued when the current management team is considered ineffective or incapable of implementing necessary strategic changes. Both structures aim to improve firm performance, but they differ significantly in governance dynamics, operational transition risks, and the extent of organizational restructuring required after acquisition. Venture capital represents another important category of private equity. Venture capital funds provide financing to companies in the early stages of development, often focusing on innovative businesses with substantial growth potential. These firms may not yet generate profits and therefore carry significant business risk. Venture capital investors commonly receive common equity, convertible preferred shares, or convertible debt in exchange for funding. In addition to providing capital, venture capital firms frequently offer managerial expertise, strategic guidance, industry connections, and operational support to help portfolio companies grow. Although many venture-backed companies fail, successful investments can generate extraordinary returns that compensate for losses elsewhere within the venture capital portfolio. Private debt is another essential segment of private capital and involves lending directly to companies outside traditional public bond markets. Private debt strategies include direct lending, venture debt, mezzanine financing, distressed debt investing, and structured credit products. These investments are attractive because they often provide higher yields than publicly traded fixed-income securities. Private lenders evaluate borrower cash flows, collateral quality, capital structure, and covenant protections before extending financing. Distressed debt investors may purchase the debt of financially troubled companies at discounted prices with the expectation of restructuring or recovery gains. However, private debt investments involve substantial credit risk, illiquidity, and complexity, requiring specialized expertise in credit analysis, legal restructuring, and bankruptcy procedures. Private capital investments are also valued for their diversification benefits within institutional portfolios. Because private market investments are less frequently traded and influenced by different economic drivers than public equities and bonds, their returns may exhibit lower correlations with traditional asset classes. In addition, private capital managers often create value through operational improvements rather than relying solely on market appreciation. These characteristics can improve overall portfolio efficiency when combined appropriately with traditional investments. Nevertheless, investors must recognize that diversification benefits may decline during periods of severe economic stress, when correlations across asset classes tend to rise. Illiquidity, valuation uncertainty, and long investment horizons also require investors to maintain strong liquidity planning and risk management practices. Overall, topic demonstrates that private capital is a sophisticated and influential segment of the alternative investment universe. Through private equity and private debt strategies, investors seek enhanced returns, active value creation, and portfolio diversification beyond what traditional markets typically offer. Leveraged buyouts, venture capital financing, direct lending, and distressed debt all represent distinct approaches within private capital investing, each with unique risk-return characteristics. Success in this asset class depends heavily on manager expertise, governance oversight, operational execution, and disciplined risk management.